has a track record of outperformance. On the street, he's sometimes referred to as the Mid-Cap Mogul. Quite naturally then, Kenneth Andrade of IDFC Mutual Fund is the first guest on our brand new segment, Alpha Managers. Kenneth Andrade manages the IDFC Premier Equity Fund that has a corpus of over 4,300 crore rupees. Focused on mid-cap and small-cap stocks, the fund has delivered an annualized 23% return over 5 years and is considered the second best performer in its category. Currently, almost a fifth of the IDFC Premier Equity Fund is invested in engineering sector stocks. Services, manufacturing, financials and consumer durable stocks make up most of the rest. Andrade was an early investor in Page Industries, a stock that has proved to be a multi-bagger. Recently, his fund increased its investments in VA Tech, SKS Micro, Exide and Reddington India. It also exited USL via the recent open offer by Diageo. Last year in April, Andrade launched the IDFC Equity Opportunity Fund. With over 300 crore rupees under management, the fund is invested in small cap stocks in sectors such as chemicals, engineering, metals and mining, manufacturing, auto and utilities. Key investments include Ambika Cotton, NBCC, Chambal Fertilizers, Sundram Fasteners, Tata Sponge, Ceylon Exploration, FAG Bearings, Engineers India, Hexaware and Whirlpool. Year to date, the IDFC Equity Opportunity Fund has returned 47% versus a BSE 500 return of just 21.5%. And since inception, its returns exceed 60%. Kenneth, thank you very much for joining us as we debut this new segment, and thank you for being our very first Alpha Manager. Let me start by asking you what you make of where we are in the markets right now. It's a slightly general question, but just to get a sense of what kind of expectations or assessment you have of continuing mid-cap outperformance.
Well, it's been a category that's done extremely well, not for the last year, but it's been in continuation for, I would like to imagine, for the last 4 or 5 years. There have been a lot of opportunities around the way. I think what's changed right now is that the sentiment, the environment has gotten much better, more conducive for companies growing in this space. And once you have that sentiment of stabilization of the economy that takes place, it's left for individual entrepreneurs to put their business models together and run with their business models. So I think it's an easier format right now to work with. You've got you've got the macros which at least in India have fallen in place. You will have demand clip up incrementally, and you have capacity which is with latent capacity on the ground which can add back to earnings.
Kenneth,
so it's relatively
easy space. Kenneth, but how would you describe the mid-cap space at the moment? Exciting or exciting and dangerous given the run-up that we've seen in some shares?
Well, if you okay, look, it's a category where the universe is around 1,500 companies. Okay, close to about 700 companies are investable or can be invested by mutual funds or large institutional investors like us. Of the 700 companies, you have to put it down to or bring them down to about 60 companies, which is about 10% of the of your investable universe. If you've been able to do it in a fairly regimented manner for a very long period of time, it is not dangerous at all.
Okay,
if I step back into history, mid-caps have never lost money for a lot of people. They've actually been the better part of the market to be in if the cycle is in your favor.
I suppose it depends on when you enter the cycle, but let's talk a little bit about what you like in the mid-cap space as you reduce that universe of 700 down to about 60 companies that you want to pick. And I'm looking at, for instance, your Premier Equity portfolio, and the engineering allocation in that portfolio seems to be the highest, if I've got my data right. But when I look at your top holdings, there are a large number of consumer-facing companies there, Kenneth, that hold prime position. What do you like more, the engineering space, the consumer-facing space? Is it the financial space at this point in time? How are you looking at the variety of sectors?
When we put a portfolio together, I mean, it's not really important as to which industry we effectively buy, but as individual investors or as institutional investors, we really buy capital-efficient business models. And when you're effectively going in for capital efficient business models, you have to have a scalable industry that these companies can grow into. I think if you put both of them together, you will be able to find the right company in the right space. The industry categorization it comes by default of your ability to pick the right company. So I don't think we constructed it by saying that we want large engineering and our top 10 looks very consumer facing. But when we buy a company or when we put our heads to work and try and identify a business, we'd ideally like to live through that entire business cycle with the company from its inception till the category actually matures itself out.
All right, so then let me alter my question then. How come so many of your top holdings are consumer-facing companies?
Incidentally, they became my top holdings because a lot of these companies have been around for the last 7 years, and we haven't altered the structure of the fund or we haven't incrementally added to these positions in the last 3-4 years. So they've done well because, like I said, execution is all you need to watch for, and if the execution plays out well, these companies automatically deliver the returns that is required.
Sorry.
No, go ahead.
And when do you start seeing red signals? When do you start? Let me ask you that as an example. For instance, you were a big investor initially in Educom. By 2010, you had completely got out of the company, and rightly so. So what sets your antennas off?
Okay. 2 parts. One is from an industry, and second is from the balance sheet. From an industry point of view, any franchise which has got pricing power, will continue to deliver long-term growth and profitability to its shareholder. So we look for pricing power. Pricing power usually gets destroyed or completely vanishes once there are too many participants in the same industry. So to put it simply, we do not like industries that are fragmenting itself, or we do not like too many investors chasing the same industry and creating incremental capacity out there, because that helps nobody. It doesn't help the existing incumbent. It doesn't help new entrants because the cost of entry into the business is high. And at the end of the day, the shareholders and the bondholders both have to hold the company till the industry actually revives itself. I think that's one flag that actually sets one thing that we look for in any industry. The second is from a company perspective. From a company perspective, for incremental growth, if he's putting in incremental capital, the incremental capital that goes into funding incremental growth is there for an extremely long period of time, that's something that we don't like. So if you look at the portfolio construct that is there, we have a lot of companies out there which do not have any financial leverage. Or incremental financial leverage. We do not like the financial leverage story simply because we like our companies to grow into an economic environment which is stable and leverages balance sheet, rather than find itself at the beginning of a cycle with a leveraged balance sheet. I think that doesn't work for us. So balance sheets at one extreme, and secondly is the industry construct and how many players are actually coming back into that industry.